Hey guys, it's Big Mike. Like always, I'd like to thank you for being here today. So today, FuturesTrader71 is back. I asked him to come back and talk about a few very popular subjects that I'm really looking forward to discussing with them today. Those are risk, position sizing, scaling, just basic trade management principles. And he's got a lot to talk about today. I know there's going to be a lot of questions throughout the webinar. I would like to remind everybody that the webinar is being recorded. So if for some reason you need to leave or you have some type of a problem and you can't get back into the webinar, the recording will be posted on BMT sometime tomorrow. As you guys have questions, type them into the box. You cannot see each other's questions, but the questions will be forwarded to FT71, myself, and to Anthony at Vancar, and we'll do our best to answer those questions as we go along. All right, guys, here comes FT71.
Good afternoon, everyone. Can you all hear me? Just a quick mic check. Okay. So thanks for coming in. A lot to cover today, so we'll try to whip through it. We're going to try not to make this into a feature film length webinar like last time. We'll get to the nuts and bolts fairly quickly. So we're going to talk about risk, like Mike said. It's probably the most covered subject, but when it comes to trading, for some reason it doesn't sink in with most people. So I'm here to reinforce it, maybe give you a different perspective, so that you can give it the respect it's due. I have to go through this disclaimer because I'm sharing trading information with you. I'm required to tell you that there's a risk to trading. It's trading futures and options and other complex instruments has a substantial risk. Let me turn down my news feed here. Carries a substantial risk of loss, and it's not suitable for all investors. And also, the information I'm sharing with you is not intended to tell you how to trade, so to speak. It's intended to help reinforce some of the things that you have yourself discovered and possibly get you to look at other ways to view the market. So this is not investment advice. So let's look at risk. So this is what we generally know about risk. Take care of risk and the rest will follow. There's the curse of being undercapitalized. There's a difference between emotional capital and its connection to performance and execution. Does anybody not know what emotional capital is? It's an important thing for you as a trader. Okay, getting crickets. Emotional capital is what happens is you take trades. Generally, people measure their success by whether or not they made money or lost money, and the better and more important way, and I hope to leave you with this impression, your success is not a function of your profits and losses. Despite the urge and the tendency to want to measure your success that way, your success depends on how well you execute your plan, how well you execute your edge. So emotional capital is this almost currency that happens within your psychology, within your mind, in that as you execute properly, you gain confidence. That's more emotional capital. As you get dinged or take a bad trade or take a daily stop loss and things like that, you debit your emotional capital, you become less confident. Money is made or lost based on emotional capital. The more confident you are based on the repetition of this exercise of trading and taking your edge, the more emotional capital you have, the easier it is for you to see the market for what it is. When you're low on emotional capital, which I would say the great majority of traders are, and most don't know how to help that, And that was my function as a prop shop owner, is to support people in gaining their emotional capital. So as time goes by and you kind of take your losses and take your winners, and all in all end up trading well, you become more and more confident. As you become more and more confident, your view of the market absolutely and completely changes. I'm sure many of you who've traded live have had one of those days where they came in, they did their homework, they expected it to be just another trading day, and they take one or two losses right off the get-go, and then for some reason the market just looks like a big scramble. No idea what it's trying to do, where you should short, where you should get long, and then generally that starts to create an emotional response, which then creates random trading, which then creates lots of losses and just complete control, and I call that monkey trading. So emotional capital is that thing that you as a trader have to protect. You have to protect your emotional capital more than you'll want to protect your financial capital in your trading account. You want to do everything you can to prevent yourself from sabotaging your emotional capital. Both are important. Your emotional capital in a way is tied to the size of your account, so forth. You know, if you take an account from $10,000 to $1,000, that's not doing very much for emotional capital. So that's an important thing. And then the other thing is risk. If you have not ever been humbled by anything, the market will humble you through risk. So any disrespect or lapse in judgment of the importance of risk is going to cause you to get slapped around. Everybody has been slapped around. Everybody gets slapped around, and there are ways to kind of deal with that. A lot of people don't deal with it very well. But risk is the great humbler. It's a lot like being an alligator handler in Florida or something, you know. You may know the alligator that's in front of you forwards and backwards, and you may have stuck your arm in its, you know, in between its jaws many, many times. But it takes one moment where you become unaware for that jaw to snap down and tear your arm off. So risk is not something that you want to be lax about. It's having a risk plan and so forth is the seatbelt to that fast race car driver. So you want to respect risk first and foremost, okay? Confirmation. So the other side of this is confirmation. Hang on a second. Sorry. Confirmation is something that people talk about, especially on boards like Big Mike's and others, and I hear it in chat rooms on Twitter all the time. You know, I'm waiting for confirmation. Confirmation is, as they say on the trading floor, confirmation's for Catholics. Confirmation is not your friend in trading, and here's why. There are two types of risk that a trader takes. There's price risk and information risk. Okay? Does anybody know what price risk is? Anybody guess? Come on, let's keep it alive. Price risk, information risk. All right, I guess I'll be doing all the talking. This was covered a long time ago by a guy named Justin Mamis in a book called The Nature of Risk. Very, very old but very good book on risk. Price risk is when you risk taking a worse price for the benefit of more information. Price risk is when you pull your order where you wanted to enter the market against, let's say you wanted to get long and your long is at 83 evens today. on the S&Ps, and the market comes tumbling down towards you this morning, you pull that order, even though your homework shows that that's where you want to get long, you've set your stop at 80, blah, blah, blah. You pull that order because you want to see how the market behaves at that price. So you're taking price risk because you want more information. Those two do not go together. You're either going to take price risk or information risk. What is information risk? Information risk is taking the price without knowing more about what's going to happen. Okay? So that's the difference. Price risk is when you decide to risk getting a better price for the benefit of getting more information or confirmation. So people will use whatever, a higher low to get long before they take the trade or whatever. Information risk is when you're willing to take what you think is a better price and risk not having enough information. Okay, so those are the two concepts. Which type of risk do professionals take? Information risk. Professional traders, that is. I'm not talking about fund managers and those types. I'm talking about professional traders. Information risk is why is that? Because taking a better price puts a trader closer to his or her price point where he is wrong on the trade. It's more important to me, and I'll get into why this is later when we talk about probabilities, which started, I guess, a big discussion on Big Mike's board. I never know what's going to happen. I accept this as a trader. This is ingrained in me. This is in my blood. It took a long time for me to accept this because I came from a scientific background. I was an engineer. And so generally those people with a higher education and are more averse to risk will take price risk over information risk. They love information. They love more information, more confirmation. I need more and more confirmation. And so by the time they get that, they're getting in at prices where others may be scaling out. I often find that when I posted my trades on Twitter, I found that others who were posting their trades also were stalking to get into a trade at the first scaling point where I was trying to take profits and reduce risk. And so it's better for me to always take information risk because I never know what's out there. I'm not able to know. I don't have a research department, and I certainly don't know what Bernanke's going to say. I don't think anybody does, or what's going to happen next around the globe. We're all tied together, and it takes one trader anywhere on this planet to nullify your edge for the very next trade. I hope you realize that. It takes one trader, one participant to go in the other direction in order to wipe away your edge. So how important is information to me? It's important to an extent. It's important in the way I use volume profiling and in the way I look at the market. But it's not the factor that makes or breaks the trade for me. What makes and breaks the trade for me is the price I take and the way, and mainly, mostly, how I manage the trade. And that's a result of my psychology, my belief structure, and so on, and that's what I'm covering today. Given that the outcome for the very next trade is 50-50, this can be justified as the better risk bet. So the outcome, and I'll cover this again later, and this is the reason we debated it last time, the outcome of the very next trade under any condition in trading is 50-50. The very next trade's outcome is 50-50. So for me, it's more important to get more trades, more samples, so to speak, to test my idea on the market than it is to wait for that trade where I'm, you know, absolutely right, because that is just a false, that's an illusion. And what most people do, and in my experience, even new traders that I've backed, and they soon realize it's not true. It's what most people do is they try to be right. Trading is not about being right. You have to get that through into your deepest belief structure, is that you're not looking to be right. What you're trying to do is just play the better probability. Okay, and we'll talk about setups later. But this is the difference between the person swinging, you know, 300 lots in the S&Ps and the person trying to make a living or trying to make a turn with a 1 lot. Is the guy swinging 300 lots of course has a much bigger account, but also understands that he just doesn't know. He doesn't know. He's just executing on an edge, but he doesn't know what the outcome is likely to be. How big a risk do we take when trading futures? So let's go through the numbers real quick in case some of you here are familiar with trading equities but not futures. Many people trade equities without risk, without margin. And so if you're buying a share of Google, you're putting up the entire value of Google, whatever it is. I don't remember what it is right now. I don't trade equities. But let's say it's $600 and you have to have $600 for each share that you buy. And some brokers will give you, I think, 4-to-1 on equity trading and margin. So you can actually own 4 times the amount you have on deposit. In futures, 1 S&P point is worth $50. The S&P is trading at approximately, it's quoting right now, $13.89 even, but let's round it up to $1,400. 1 S&P future contract is worth $50 times $1,400. It's $70,000 notional value per contract. You are controlling, with that 1 contract, $70,000 worth of assets. Okay, so if you were delivered on that future contract, that's what it would be worth. How much do people have on deposits? Trade the CS contract. Most of you, and since I started this brokerage and much of the questions that come into the brokers here is about, you know, one of the main questions people ask is, what commission do you charge, and do I get $500 per contract margins or $400? We with our clearing firm, we can actually offer $400 margin. Nobody gets that. I don't give that to anybody. Nobody gets $500 margins. But most brokers will give you $500 margins, intraday margins, for futures. That means that for $500 you can control $70,000 worth of notional value for the day. How much risk are we talking about here? We're talking about 140-to-1 leverage. Remember, in brokerage, if you have a good credit history and your broker wants to, they can give you up to 4-to-1 leverage. In futures, 140-to-1 leverage. Much bigger money is made and lost in futures than in equities. And it's for that reason, leverage. That's why there's risk disclaimers all over the place, because it's a pretty big, you know, it's like somebody who's used to shooting an air gun suddenly being given, you know, a Gatling gun to go out there and play with. So we don't give anyone the 500-to-1 $500 contract margin, and this is why risk is key for what we do. I trade futures. I started out as an equities trader, and I prefer futures. It's a more level playing field, and if I'm consistent and if I do well, I have a much bigger opportunity in futures than I do in equities. But with that greater opportunity, there's the equilibrium, which is risk. So this is why this is an important topic. So how smart is it to trade a $500 margin? Not very smart. A $5,000 account should never have 10 contracts in the S&P. You wipe yourself out real quick. But under a controlled environment, this leverage can really build up your account very, very quickly. But again, under control, a controlled environment. What is the point? The point is this. Your mind, beliefs, and psychology are the greatest hurdles to your success. So you can spend a whole heck of a lot of time looking at charts. You can spend a lot of time paying for a room or a course. You can spend a lot of time discussing a particular indicator and so on and so forth. But really, even once you figure out what that indicator is and how it has worked in the past, you're still dealing with the hurdle of your own beliefs and your own psychology. And this is, I cannot overemphasize the importance of having the right attitude to trade. It's the thing that's going to stop you from executing your perfect plan. If I gave you the Holy Grail, if it even existed, and you could execute it, the thing that's going to get in the way of you executing it is your own mind. And it's for good reasons, okay? And then a very close second to that is undercapitalization. Those are the two things that are working against you as a trader. Not having enough money to trade means that you're going to be over-leveraged and you're not going to be able to trade enough times to actually see what is happening intuitively almost in the market. So psychology, undercapitalization, your biggest foes. Every trader knows so much about trading except how to take a loss. Losses are a trader's kryptonite. This is where all of our weaknesses are. We do not like to lose. We equate losing with failure. We equate losing with not doing well. But the fact is, just as our body survives with oxygen, I've used this analogy before, in case you've heard it in one of my other talks, just as we use oxygen and we need oxygen in our body, we inhale it to gain it, but we have to exhale it to then take a newer, cleaner breath in, more oxygen. Losses are like that exhale. It's a necessary part of being a trader. Accept it. Losses are something you want to embrace in the sense that you want to make them happen quickly. You want your loss to just, that's what makes a good trader. And I started out as a scalper, so I was trading a couple thousand round turns per day, so I had a ton of losses every day. So you just become desensitized to it. You just cut it, you cut it, and then you look for the next trade. And this is what, believe it or not, this is what people are really, really horrible at. People are just awful at taking losses. If I could spend a day with a person that is having a hard time trading, I would probably spend it on showing them how to take a good loss. So I say here, losses are a trader's kryptonite. It's everybody's weak point. Okay, and it's what causes emotional capital losses and things like that. It's because we believe that losses mean we're bad and so on. So I think you get the point. Meet your monkey. The monkey is this programming that exists within you that is intended to protect you in times of distress. So your monkey is that thing that causes you to drop to the ground when you hear an explosion. The monkey is that thing that causes you to quickly react if a person runs a red light and is heading your way. It's meant to save your life. It's a stress response. Trading for some people, for most people, is very stressful. So it engages that same response. Well, that response works against what you're trying to do as a trader. I'm not a psychologist. I learned this the hard way, losing hundreds of thousands of dollars and dealing with my own issues and a whole bunch of traders' issues that worked for me. So I know this to be the truth. And so you have to spend a lot of time becoming aware of that monkey, becoming aware of what is your behavior when you're under stress. Are you someone who becomes emotional and becomes reactionary, or are you someone who just sticks to the plan? And there's no way for you to ignore or get rid of your monkey. But what you have to do is just become aware that it's there and come up with ways to just let it be. Kind of like I used to tell my traders, just pull up a seat for it. Let it sit next to you. It's okay. You don't have to react to your emotions when you trade. And that's much easier said than done. Why does this monkey exist? Your education, intellect, and life experiences have reinforced the need for you to be right. And so you spend a lot of effort in being right. If you trade while you believe that you are right, and only when you believe that you are right, you're going to have a very hard time accepting that you are wrong. Okay, so most people spend most of their time trying to find the trade that makes them right. But fact, the very next trade has an equal chance of being right as it has for being wrong. Fact. Let's say it again. The very next trade, despite the most perfect conditions for that setup, has an equal chance of being right as it does for being wrong. Period. Because you're dealing with market emotions, you're dealing with market psychology, crowd psychology. Okay? It's like an election. The candidate that may seem like the perfect president, good-looking, intelligent, successful, has governed a state or has been in the Senate and understands government, good with diplomacy, foreign diplomacy. But then when the crowd goes to vote, you may be in for a shock because you find that the guy who grew up on a farm, doesn't know the first thing about China or any of our allies, ends up winning. And it only takes one vote to negate everybody else, everybody who was for the president that you thought would win. It's the same in trading. You're dealing with crowd psychology. It's impossible for you to determine what's going to happen next, and every trade has a 50-50 chance. So what most people do is they focus a serious amount of their effort in being right, when really all you need to know is what is going to happen, what is more likely to happen over another, what event is more likely to happen over another. Okay? So I'll show you an example in a chart. Give me a second. So this is what I call a composite. This is a daily chart that shows me the volume going back to September 7th of 2005. This is my big picture view of what the market's doing. I'm a day trader, so I'm not looking at weeklies, monthlies, and so forth. This chart's telling me this much volume in contracts has traded at each one of these prices running down the right side. These are daily bars, regular trading hours only. The market goes from balance to imbalance to balance, as I covered a little bit in the last talk. Today, expectation opened below the last balance area, which was up here. Expectation is rejection of 91.25. It got to 90.75 within 2 ticks, and then rotation down to the next rejection area, which is 82. Okay, so the market rushes down to 82. I got short this morning around 90 or 90.25, and just following the plan, looking for failure below 87, 88.5, looking for failure again below 84.25, which puts us in this thin area from Fed Day, looking for a target of 80.25 and a main target of 77. I don't know what's going to happen, but since I got this idea that the auction has opened below the prior value, and if it cannot push higher, it's likely to push lower. That's all I need to know. That's it. That's my edge. My edge is in knowing that it is more likely to rotate down than up. That's all I need. I do statistical analysis. I do all these things, but it's not as powerful as the big picture idea like you saw here. Okay, that's just an example. And then I use my intraday chart to refine what has happened in a day. So you could see it opened right at 87, right at the area that I showed you before, this fat area, 87.75, 88.5, opened right there, tested higher, failed, went right to what's called a microcomposite low volume node, MCLVN at 82.50. This line was there before I showed up this morning. It's not one I put in once the market started. So 82.50, the low of day, was really hoping for a push down to 80.25, which is where this thin volume ends, and it starts to have acceptance down here. But it didn't happen. Do I know what's going to happen? I don't. I don't care what's going to happen. All I care about is one thing is going to happen over another, and I take advantage of it. And that's all I need as a trader. So what does this have to do with the monkey? It basically tells us that because of your background, your education, the fact that you're educated and intellectual and so forth, that working harder, especially on the technical side and having discussions about technical stuff, makes for a better life, therefore it makes for a better trade, the next trade you take. That is simply not true. If you want to focus on anything, focus on understanding the risk of the trade that you're taking. Focus on understanding yourself. We're taught that 2 + 2 = 4. That's something you learn in probably kindergarten. 2 + 2 = 4. In trading, 2 + 2 = 5 today, 3 tomorrow, 4.2 the day after that, 4.7 the day after that, 3.9 the day after that. That's a fact. There's a random distribution of prices in the market. Okay, the market action. Now let me correct this so I don't start another debate. Market action is not random. Okay, there's a certain pattern to the behavior of participants. Just like if I called you a name, or if I saw you in the street, came over and shoved you, I should expect a certain reaction from you. You can either run away because you think I'm a big guy and don't want to, but in most cases you'll turn around and you'll want to fight. That's your monkey kicking in. So there's a certain, the market is kind of the same. It has a certain tendency to behave in a certain way. But it's not absolute. It's just because it's made up of numbers does not mean that it's simple math, because it's not. You've learned growing up that losing is bad. Okay? In trading, losing is not bad. Losing is a good way to prepare yourself for the next edge. My worst clients are ones that get into a trade and then they just sit and they hope and they sit and they hope, and the market could have moved 12 points against them and they sit and they hope, and it's incredibly frustrating for me because as a prop guy, I just blow them out. I just blow a trader out. I just tell them to get out. But since they're trading their own money, I can't do that. But it's just an incredible attachment to a positive outcome that keeps them in that trade. So they may have been going for 2 points for that trade, but they'll take 12, 14 points of risk. Very bad for your emotional capital. Very bad for trading, and completely unsustainable. This is a complete disregard for risk. I'm sure most of you are doing it. You just need to be aware that you're doing it and just stop. Take your loss. Losses are good. Take your loss because the monkey calms down and you can't see the market for what it is if your monkey is active. It's, again, an analogy I've used in the past. It's like driving drunk. When you're trading and the monkey comes on, it's just like that guy who's leaving your party after having had 14 bottles of beer. And then when you tell him, hey man, are you all right to drive? It says, oh yeah, of course. But he's not aware that he's impaired until he gets in a car and slams into a tree, or worse yet, kills somebody. And most people think they can drive when they're tipsy. Most people do, just like most people think they can trade with their monkey, but they can't. So taking a loss resets it. It clears your mind. It allows you to see the market for what it is. Additionally, over time, taking a loss creates another sample or creates another trade and another trade and another trade. And that's what most of you and myself, I'm not a master at this. It's an infinite learning experience. But the more trades you take, the better you get at trading. Except that because of the reasons I stated earlier, undercapitalization and so forth, you're not allowing yourself the number of trades. Therefore, it becomes a lot harder. And so what happens is over time, people just chip away at their account until they have to deposit more or go do something else. And that's really why I started a brokerage. It's to try to change this behavior and change the brokerage model entirely, as discussed in the prior webinar. Anyway, to move on, the belief structures that you have lead to a primal response and two risk profiles. You're either risk averse or risk seeking. Certain personalities will try something and they'll throw themselves at it, no problem. Certain personalities are always going to go for the safer bet. I'm going to go and get a government job to get a pension, to get and give up a higher paycheck, for example, versus I'm going to go out and take the risk of starting a business. There's just different personality types. However, within those personalities, that's the big picture personality, within those personality types, your risk aversion and your willingness to seek risk changes with your trading. So when I get an email from a follower or somebody sends me a tweet and says, I'm really kicking butt. I've had the best winning streak I've ever had. I've been up my target for the day 9 days in a row. My immediate response is watch your risk, because what happens is they move from probably being risk averse to being risk neutral to being risk seeking. As success builds on itself, you become more and more risk-seeking, and you think you're invincible, and you throw away your risk plan and the structure that you've created. You get to the point where you are that guy who's drunk and doesn't know it and is driving. You're basically thinking, hey man, I figured this out. I'm just going to keep trading. Yeah, I know I've hit my limit for the day. Who cares? I can make this back. And that's when you take a huge emotional capital debit, and then you start over from scratch, essentially. Anyway, I won't get too much into that. Webinar 3 on my website covers it in detail, so we'll move on. Again, taking losses. Show me the money. It can be argued that your success is not anchored in what you know and how you trade. It is based on how well you lose and how well you manage risk. This isn't a myth. This is not something that I'm not an educator. I'm a trader. I'm not polished. Like my slides are not even polished. I'm telling you this from my own experiences. I'm telling you this just like it is. If you take care of the downside, if you take care of risk, the upside eventually shows up. It's just a matter of playing the probabilities, really. So always keep risk in mind. Take the trade. Your stop for every trade is your ante. If you've ever played poker, you have to put a chip on the table to be able to get the next card, the next hand. Okay. Your stop is your fee on every trade to find out whether or not the market agrees with you, or the majority of the participants in the market agree with you. That's how you should look at your stop. If you just change your perspective, tweak your perspective a little bit on trading from what's traditionally shown in books and what you've learned from others, to this is a game of pure probability play, just like gaming is. And if you just look at risk from the perspective of, okay, I've done my homework, I think I have an edge, I think it's probably going to, go down here and then probably stop and turn around. Your stop, and that's why you have to let your plan play out, your stop is your price, or is your price of admission to find out if that trade is going to be agreed to by the market or not. That's how I look at my stops. When I put a position on, I'm placing a bet that I might lose a point, point and a half, whatever it is in the S&Ps, depending on the situation. And I size my position aggressively or not, depending on how far that uncle point is. And I know that the money that I'm putting on the table is my fee to go on this ride to find out where it can take me every time. Take care of the downside, and the upside takes care of itself. What the bleep does that mean? It means size your position so that they're only risking a small portion of your account on each trial. Okay? You don't want to take a trade and risk 20% of your account. That's what happens to people who get into a loss and then freeze up, and then the market just keeps going against their position. Keep it small. Some percentage of your account, 1 to 5%, for example. Take your losses so that you can be clear and ready to take the next edge when it shows up. Take that loss. Again, I said it earlier. Take that loss, because that's the only thing you can do to free you up to take the very next trade. Okay? Do not take consecutive trades in the same direction on one setup. I have a rule in my risk plan that says if I'm looking for a short like this morning, and I actually took a short on LEI on the indicator, the leading indicator number, I actually heard it wrong on the news feed. I heard I heard 0 expecting 0.6, and it came out to 0.7 versus 0.6. I shorted right on the release, and I shorted like 88 quarter, something like that. And I ended up taking a loss up to 90.50 or 90 quarter, and then I got back in. I'm taking that loss so that I can be clear on what it's trying to do next. There's something I didn't figure in, and so I need to take the loss so I can clear myself for the next trade. So if I had taken that 88 quarter and taken it again at 90 quarter, which is where I took it the second time, which worked, back down to 82.50. If I had taken it a third time for a stop, if say the second trade that I took that worked out didn't work out, and I took it a third time, I am off the shorts, even though my plan was that I was looking to short anywhere between 91 quarter, 91.75, and 95 quarter coming into today, given the open of where it is. If I had taken the shorts and spent all three of them on the 91 or 90 area, I will not take that 95 because it clouds my judgment. We may end up being in a trend day up, as we've had in the past. It gaps down and it goes straight up and makes new highs. And I'm not going to keep selling a trend day up. I have 3 chances, so I better make them count. Limit your losses on a daily amount. So set a limit for the day. You reach that limit, you take your losses for the day, you're done. I don't quit when I take the 3 losses, the 3 consecutive losses. I just cannot take the short. That setup is gone. That setup is done. Okay. Yes, 3 strikes and you're out. Okay. Do not take consecutive losses in the same direction. Limit your losses per day. Even though you traded well, you hit your daily loss limit, you've got to stop, because this is the only thing that's going to provide you with an opportunity to come back tomorrow and trade again. daily loss limit are like a seatbelt. You know, you think you're a great driver, you think, you know, you've driven for so long, you don't think you get into an accident, but if it does happen, you're in deep doo-doo because you didn't have your seatbelt on. So daily losses are like a seatbelt. Use them. They're important. They're on your side. They're protecting you from yourself and your monkey. Misspelled, no, and be perfectly okay to lose the amount of your stop in order to find out if your hypothesis is supported. I mentioned that earlier. How are we doing on time, Mike?
It's fine. You can go as long as you'd like.
Position and stop sizing is important. So what I did here is I took a $100,000 account and I said, I'm going to risk a certain percentage per trade, and I'm going to have to stop trading at $2,000. So if you risk 1% per trade on a $100,000 account, you have 390 consecutive losses that you can take to run that down to $2,000 and have to stop or deposit more money. If you use 2% per trade on your account, that 390 drops to 194, drops substantially, right? If you use 3%, it drops to 129. If you use 4%, so I'm adding risk on a linear basis. I'm going from 1 to 2 to 3 to 4 to 5. But the number of trades I can take drops on an exponential basis. Do you all see that? Is that significant? I'm sure mathematicians will understand this chart right away, but others may not. So the more you risk per trade, the quicker your equity could drop. The probability that you will take 390 losses or 194 losses in a row is phenomenally small. That's a fact. So, but what I'm trying to say is going from 1 to 2% cuts you down from 390 to 194, but going from 2 to 3 cuts you down to 129, and on and on and on. It's an exponential relationship. Okay, so you're risking a certain amount of your entire account per trade. So you're trading a $20,000 account, you risk 1%. Okay, $200 on every trade. So on that $20,000 account, if you took a 1% full stop loss in a row, how many trades can you take on that $20,000 account before you have to deposit more money or stop trading? That's, in this situation, it's a $100,000 account. This is just an example, a very rough example of how risk is exponentially related to how much, how much of your account you're trading. So the conclusion you can draw from this is capitalization. Capitalization is huge. Being undercapitalized is really the plague of the average trader. It's tough. It's tough to trade well when you're undercapitalized. If you're trading a $2,000 account on an instrument that has a notional value of $70,000 per contract, you know, what chances do you have? That's why when I started my brokerage, the minimum was set higher than that. It's for the client's better interest, not for my own. Probabilities and urban legends. So I'm going to get into the thing that we discussed, that was discussed a little bit last time and caused a debate. So let's go through probabilities and these legends that we have on trading. They come from books and lectures and stuff by others. Many, I suspect, don't really trade. But the idea that you can study prior market action and it would represent the future is a false one. So you could sit here and look at 20 years of data and come up with some conclusion. And that conclusion applies to the very next trade is not true. It's an urban legend. So The idea that if you have an action that has occurred 90% of the time in history means that you have a 90% win outcome on the very next trade is not true. Because unless you know what the outcome of the next trade is before it happens, it is random. If it's random, then you don't know where in the distribution of information that's coming in, you don't know where that winner or loser is going to come in. You just don't. And those who argue against this are people who are looking at the market as if it's a historical data set. It's not. It's an infinitely continuous set of variables coming in with every tick. Every tick gives you a new variable that might change that 90% and drop it to 88, it might take it to 92, might drop it to 72. You know, it just depends on how much data you're. So looking at the past is not an indication of what's going to happen next. It's like we do with our trading systems. We say past performance is not indicative of future results because it can't be. You may be entering into this data set at the peak equity and might see a draw, which unfortunately happens to some of our clients. You might see a draw from that point going forward. You might just take loss after loss after loss. You might be in the 10% of losses in that data set, let's say, one after the other. So the outcome of the very next trade is 50-50. Not saying that the outcome of all trades is 50-50. The very next trade, the outcome is 50-50. That's the difference. There's not much more to debate on this because the market's not made up of a fixed set of numbers. Okay? So it's a fixed set, it's a set of numbers that's continuously flowing. So you can study the heck out of it, but in the end, I personally, as a trader, I'm just looking for one thing to happen over another. Does that mean 51% over 50? Maybe. A lot of what I do has to do with trade management. I do a lot to skew my edge through trade management, which a lot of good trading systems do as well, by scaling and so forth. That's why I'm not an all-in, all-out trader. I can't be. My psychology doesn't support it. My monkey's too big for that. I do very, very well with scaling, and scaling allows me to take more liberty and have more errors, so to speak, in my entry. Okay, we'll talk about that in a little bit. What is the definition of random? The definition of random is not knowing the outcome of the very next event before it happens. And in the market, you don't. I don't know what the outcome of the very next trade before it happens. The problem of trading randomly in a random outcome environment is huge. This is what happens to most people. I know there's a ton of questions going through, and I'm trying to peek, but I won't be able to answer them. Oh, maybe Mike can help me with that later. The problem with most traders is that they come up with something. They come up with what they perceive to be an edge. They read it on the board here, or they read it in a book or whatever. Then they study it on the past. Then they try to trade it. But what gets in their way is their monkey, because everybody can make money on sim. People have a hard time making money in real life. Why is that? Even if you penalize your entry and your exit on a simulator by one tick each, your performance does not follow what you did on the sim, and that's your monkey getting in the way. Don't underestimate its power over you, over your actions. And so what happens is they start to trade that plan, whatever it is, and then what they do is they suddenly change it. It doesn't work. They take 3, 4, 5 losses in a row, and it shatters their confidence. And so what they do is they go and they change the plan. So they've had a sample of 5 trades, let's say. Even though they've studied a year's worth of setups, of 5 setups a day. They take the next 5 trades and they're like, oh, this sucks. And then they throw it away and they look at something, oh, maybe if I include this, maybe if I include this one extra moving average or whatever, maybe if I follow this guy, FT71, and get his stuff, maybe I'll be able to figure it out. I'm here to tell you it's following me or whatever is not going to help you unless you're ready to accept that it's all based on probabilities. And that's really what I emphasize. That's why I don't talk about setups. I don't teach setups. I'm not interested in teaching setups. They don't make money. Setups don't make money. Your confidence level, your ability to control risk and manage a trade does. And this is what this whole webinar is about. It's the most important topic there is, and that's why we wanted to hit it with you first. So as you take that plan and take the 5 trades and then all of a sudden change it, you're now trading randomly. And the environment's already giving you random outcomes, and you're trading randomly. You have not created enough of a sample following that exact plan, taking that edge every time, to really know if it works or not. You don't. Most people, I would say probably, I hazard a guess that it's like 99% of the people don't actually play out that edge to the point where they can understand whether it works or not. Okay, most people have not traded a consistent approach often enough to really know what works and what doesn't. That's a big issue for everyone. Okay, that's the point I was trying to make. Isn't the probability of a form of setup? Yeah, you can. A setup could be a pattern or something that gives you a better than 50-50 chance of something going your way. But whether or not it goes your way on the very next trade that you take is random. We don't know. Okay, like I said, it takes one participant. I call it the third force in webinar 3. It takes one participant to cancel out that edge and turn a winning trade into a losing trade. So the best you can do is what? Knowing this. Let's say you take my word for it and you won't go out there and invest a whole bunch of thousands of dollars to figure out what I'm trying to share with you. Let's say you accept it for at face value that you really don't know what's going to happen next and that any given participant can negate your edge. What can you do about it? The one and only thing you can do about it is manage the risk. Just trade your plan. Stick to your plan. Manage the risk. And then you could use techniques in managing the trade to improve your opportunities. I'll cover that in a minute. I'm afraid we're going to go over the 1 hour thing, but so that's what you can do. So managing risk and understanding risk is key to you. No matter what method you use, I don't care if it's an automated system, you still have to manage risk first. Campaigning. I won't cover that today. Campaigning is an advanced strategy of controlling risk through trading. Maybe I'll cover that some other time. It's going to raise too many questions to cover in the time allotted. Let's look at streaks just real quick. So knowing that there's one outcome out of 2 that can happen, on the very next flip we have on a flip of a fair coin, let's say, we have one opportunity for it to be heads and one opportunity for it to be tails. Out of two things. We have 2 outcomes. We can only get one before we take our next edge. So the streak in that situation, the first one is 50-50. Would anyone disagree with that? Are you disagreeing or agreeing? So we have a 50-50 chance, right? The chance that you have 2 heads in a row is 25%. The chance that you have 3 heads in a row is 12.5%. But look at how infinitesimal it becomes as time goes by. Again, an exponential relationship. 4 heads in a row, 6.25%. 5 in a row, 3.15, and on and on and on. 30 heads in a row, 0.0000001%. So streaks and the probability that this will happen to you 390 in a row to run out your account while risking 1% on each trade is very, very very, very slim, okay? So, toss that coin. Many of you who know me have probably heard it till you're sick of it. Coin tosses. This is where the discussion goes to probability theory and the outcome of a fair coin. An exercise I developed in 2004 for my traders was a coin toss in order to help not eliminate, but eliminate. I need to fix that. Eliminate market bias, market loss, emotional bias from my traders' minds. The exercise is simple. It's done in simulation. You use a fixed strategy, and the fixed strategy could be a scale-out strategy, but it has to be fixed. It has to be consistent. You take the trade at least 30 times on any given day, at least 30 times. You need a sample that size, okay? Okay, and so if you toss the coin and you get heads, then you enter long at market with a fixed stop, fixed target. Okay, random. We don't know what the next coin toss is going to yield, and I'm not going to get into the discussion of tossing bias. The fact some argue that if you start with heads, you end up with heads or whatever. Let's forget about that. It's a fair coin. It's tossed by some random machine or whatever. Heads is long, tails is short. You toss the coin, you put in the trade, you put in a target and a stop. So it's best if you have an OCO type trading platform like our platform, our trading platform. You can set strategies and so forth, and as soon as you click and get in, it automatically throws the orders out there and it cancels. Once one is triggered, either target or stop, the others cancel. Once the trade is complete, you wait 30 seconds, do it all over again. Okay? That's what the coin toss exercise is. So let's look real quick at some coin tosses that I did. I did these in the Russell as a demonstration. This was for a webinar I did for client only in our client only education program. So what I did is I did the coin toss in the Russell and I charted it. So we have a tool called the Trade Analyzer, which I created, which is something that was created for me, especially by a TT programmer when I was using XTrader that monitored my theoretical average and all this stuff. We'll talk about that some other time. But it gives you your fills, or the statistics on your fills for the day. In this situation, I did the Russell just because it moves a little bit faster, so it gave me more samples. So the Trade Analyzer looks something like this. Actually, I have an actual client's Trade Analyzer screen open, someone I was watching today. So that's the Trade Analyzer screen. It tells you when you have a trade on, it fills out these fields. It tells you how many tick, what your position size is, your theoretical average, which is something that I can get into some other time. It's a trade management tool. I also have a blog post on it on my website. It tells you the favorable excursion, adverse excursion, how many ticks you scaled out for, how much time in a trade, and then when the trade's closed, it moves it into the daily log, and then you can save this daily log. So this particular client, this is a live client trading today, trading the Russell today. These are his statistics, and it gives you this. This can then be saved, and it's basically, it gives you all of this stuff here. So I did the same thing, and I took the results, and then I ran some stats on them. running wins. How many wins in a row do I have? Okay, 36 trades. How many losses in a row do I have? The running win percentage, running loss percentage, running average for wins, running average for losses. Sometimes it skips through, so I actually lose more than 5 ticks. This was a strategy, remember, 5-tick stop, 5-tick target, random entry on a coin toss. Okay, and then I compute the expectancy using the percent win, percent loss, running average of the win, running average of the loss. So the expectancy is computed throughout. This is the expectancy result, and then I charted it. This was done a while ago. I did this again for a client talk that we did, and I shared it in a couple of other talks as well, so I'm just going to share it here. So the green line is your percent winning. The red line is your percent losing. The highlighted line is your expectancy, and then of course the blue lines are each individual win or loss. So this is a 5-tick target, 5-tick loss, okay, on a coin toss. Random entries. And what you want to note here is that this data ended up at 36 coin tosses. Was it 36 or 39? 36. 36 coin tosses. We ended up with about a 39% win percentage, okay? Random. I want to keep emphasizing that. So we ended up with 39%. Many people who watched Webinar 3 and did this exercise sent me their results, and there's a room in particular, a trading room, chat room or whatever, that actually made it a part of their indoctrination and for every client to do. And they sent me some of them have sent me the results. Generally, on a random toss with an equal target, equal stop, the win-loss percentage, or the win percentage, is between 30 and 35%. So this is 5-tick stop, 5-tick target, random coin toss, Russell. Let's look at another test. Now I have a 10-tick target, 5-tick loss on a random coin toss. 45 samples, I end up with 36%. Does that surprise anyone? Does that surprise anyone, or did you all expect it? You're all geniuses and you know this stuff, and I'm kind of repeating stuff that you already know maybe. Is it something that you would expect, that you would toss a coin randomly, go in the market with a 10-tick target, 5-tick stop loss, and end up with 36% winners, or an equal target to a stop loss and end up with 39% winners? I'm sure many didn't expect it. Yeah, I'm not talking about how many dollars in slippage and so forth. I'm just looking at the probability of a trade, or the outcome of a trade, winning out of the data set. 39. So for 5-tick stop, 5-tick target, 39%. 5-tick stop, 10-tick target, 36%. And then the last one, which is more like how I trade, it's a 2-lot. It has a 5-tick stop to start, just like the other ones, but then it has a 5-tick target for one contract, 10-tick target for the second. So the expectation here is that it probably won't do as well as the 5-tick, 10-tick on the whole set, right? Because if you get stopped at 5 ticks, you're going to lose on 2 contracts. But if you get your target, then you're going to win on the but if you win on the 2 contracts, you're only winning a 5-tick and a 10-tick, right? So I stand to lose 20 ticks. I stand to win 15 ticks on every single random trade I put on. But look at the win percent, 43%. Not that many samples, but it's pretty consistent. I did this again I don't know where the results are, but if I ran this through, it's pretty consistent. Okay. However, if you look at the expectancy, so let's look at the graphs. This is 5 tick by 5 tick in the Russell. Expectancy is negative, right? Negative 1.36 points or ticks expectancy. On this one, we have 0 expectancy, basically 0.02. No, the stop is never moved to break even. Never. It just stays where it is. The stop stays at negative 5 ticks from entry, and it just stays where it is. So on a 10-tick target, 5-tick loss, we have a 0, basically 0. We ended up with a 0 expectancy. You can see how smooth this graph is. It just continues to infinitum around it snakes around 0 for a while if you're in it for a long time. And then on the 2 contracts, 5-tick scale, 10-tick scale, 5-tick loss on both, stop never moving. Look at the expectancy. The expectancy, even though the percent win is 43% versus 39% versus 36%, the expectancy is plus 2.64 ticks. I hope that makes sense to you all. That's important. That's important information. So what is the point? What is the point? The point is, if you take care of your losses, if you accept and take your losses, the winning takes care of itself. That is the point of the coin toss exercise. It shows you that even a random entry can make money in the long run if you just manage your loss. You only kill yourself and really hurt yourself in trading when you have no respect for risk and you don't plan the loss and you don't take it. Okay? This is key stuff here. The other thing that I watch for when it comes to risk, trade analyzer for a person who's losing money for the day. This is an actual client. The thing you notice is MAE, which is the maximum adverse excursion. The maximum adverse excursion is how much a trade went against you while the trade is on. And then maximum favorable excursion is how much a trade went for you since the trade, from the time the trade was open until it was closed. What you'll notice with those people who have a hard time is you'll notice that MAE, the adverse excursion, is a multiple of MFE pretty consistently. They take more heat than they take a favorable excursion. Now you can argue that that's a result of their trade placement. It's actually not. I don't have the time to prove it. I can, but it's actually not. What happens here is the trade goes against them. They either panic out for a maximum MAE and no MFE, or the trade goes against them, then it comes back to entry, at which point they show a 0 gain loss, but still no MFE and all MAE. That is a symptom of trading scared. This is a client that's trading scared. Nothing against this client, great person, and hopefully will actually is getting better. But this is symptomatic. So here on the second trade, he waited 3 hours and 14 minutes. TSB is time standing by. From that first trade to the second trade, he waited 3 hours and 14 minutes. So you know he's doing a lot of thinking, a lot of planning. He has the need to be right. So what does he do? He puts on a 2 lot this time, but it doesn't change anything because it just down-ticked and it up-ticked, or it up-ticked and down-ticked, and then he closed the trade for a loss for 1 tick. This is, if you're laughing, don't, because this is so typical. When I look at our risk screen and watch what everyone's doing, the biggest symptom across the board is fear of losing. When losing is part of the game. It's like, I want to have children, but I don't want to go through labor. You know, you can't have one without the other. Again, MFE is maximum favorable excursion. It's the distance It's how many ticks the trade has gone in your direction from the time you put it on till the time you closed it. MAE is how many ticks the trade has gone against your direction, against your trade, from the time you put it on till the time you closed it. Okay, so MAE, a multiple of MFE. Remember that. Positive expectancy, 5 to 1 MFE to MAE, a little bit greater than 1 to 1 MFE, MAE. These are not practice trades. These are just trades grabbed from clients as they were trading. So what is the trading platform? I think this guy's asked it about 6 times. I think Anthony's sleeping on the wheel. It's VK Trader. You could just shoot me an email later, and I'll point you to the right person. So with a more consistent trader, you'll have MFE exceeding MAE. This trader's not waiting that long between trades. A half hour is a reasonable time to wait for the next setup. Why do I keep track of TSB, which is time standing by? Emotional trading, a person who's fighting the market will have like 2 seconds, 5 seconds, 10 seconds for time standing by. They're just emotionally trading consistently. So that's why I kept track of it for my traders. What else do I have for you here? So that's what I had for trade management and the coin toss and how that's helpful. Again, when you look at this client here, this is a client that was live today. This is the live trade analyzer. MFE versus MAE, great job. So I expect him to be positive on the day. Okay? 12 to 0, 50 to 3, 6 to 1, 11 to 9, 3 to 2. He's cutting his losses quickly. He is holding on to the winners to get that positive MFE. Okay? What else? Let's see the next slide. Scaling out versus all in, all out versus scaling in, all out. I did a study a while back taking specific setups and the probabilities of those setups historically. Setups that I had taken, trades that I had taken from my journal. And I did a study on what would happen if I went all in, all out. What would my equity curve look like? What would happen if I scaled in, scaled out? What would happen if I went all in, scaled out? And the best probability, if you truly trade mechanically, is going to be all in, all out, because you know your edge, you're mechanical about it. But the smoothest curve and the most sustainable curve and the most monkey taming curve is all in, scaling out. And this is where the tool becomes really, really, really important. The trade analyzer to me has been a cornerstone of my success. So you can create this in a spreadsheet. It's simple. And essentially I use the theoretical average. So once I scale out, so an example is I bought 1400 even, 2 contracts, a stop at 13.99, so 1 point, a target of 1401, so 1 point, and a target of 1402, 2 points for my second target. So 2 contracts long at 1400, 1 scale at 1401, 1 scale at 1402 to close the trade. My stop is 13.99. My goal on every trade as just a habit and my way of managing risk, my goal is to get the first scale. If I get the first scale, then my entry moves from 1400. Let's say I get in and I get the 1401 filled for 1 contract. My risk moves from the 1 point that's below to now I can still risk 1 point, but I've moved that stop 1 point in my direction. So my theoretical average on this trade is 1400. As soon as I get the scale out at 1401, my theoretical average moves to $13.99. So I'm taking the one contract with a profit of $50, and I'm factoring that into the trade, into the outcome of the trade, so that now my stop to break even becomes $13.99. What does that do to my original stop? So now I'm still risking 1 point. If I still want to risk 1 point on the 2 lot to see this trade go through, then my stop moves to where? Give me a guess. Give me a guess. Go ahead. Come on. Let's make it interactive. 98? Nope. 97. 97. Why? Because I was risking 2 contracts for 1 point. So I was risking 2 points. But if I scale out at 1401, my break-even point moves to 13.99, but I was risking 2 points. So to maintain the same risk on the trade overall, my stop is now 97 to give me the same risk. That's not how I trade. What I do is once I get my scale out, I move my stop or keep my stop at the theoretical average, so that if the trade, so it gives the trade much more room, and if the market decides to move adversely against me, all I'm risking is the amount that I've scaled out, that $50. Have I lost you all? Are you with me? Does that make sense? Again, I have a blog post on this on my website, and the trade analyzer is a cornerstone to that, because I scale around my trades. I put on my trade and I campaign around my trades. And as I campaign, the theoretical average, which is a huge number once it triggers off, the theoretical average then computes dynamically, tick by tick, where that new price is that would give me a 0 net outcome on the trade. So if I put on, say, a 10 lot and I scalp a 2 lot around it, back and forth, back and forth, back and forth, back and forth, my theoretical average is moving in my favor. It's moving away, farther and farther away, to the point that I can't keep up and figure out where that theoretical average is. And that's the point of this tool. If used correctly, this is, you know, I use it correctly. I created it. But when I use it, it just helps me relax. The only time I'm heightened in a trade is before I get my first scale. And my first scale is not a point. It's not. It's a function of where the trade happened and why. Anyway, let's run through this. I know I'm taking a while. Trade management. Given the simple, small sample of outcomes, what do you think is most important? Studying and creating the most perfect setup you can have. Is that important? Is that important? No. Go all in, all out. Is that important? Sizing your positions to maximize the number of trials you can get on your account. Is that important? Yes. Sizing your position. In other words, you do not want to be the guy who's risking 20% of his account on this very next trade. You're not going to last very long. Risking 20% on a $100,000 account gives you 19 trades. That's not enough to find out if you can trade or not. It isn't. Taking the loss according to your plan. Is that important? Yes. Be a good loser. I gave a talk about this about a week ago. The Fed day, I just saw a lot of stuff happening on the risk screen that I didn't like, so I got on and did a webinar, and my point, and I wholeheartedly believe in it, be a good loser. Be an awesome loser. That's your best opportunity of success. That's your best opportunity for making it, is to respect risk, understand leverage, be a good loser. I've said this before, and I'll keep saying it, be a great loser. Know that you're only trading probabilities, and perfection is not attainable. Don't sit there and wait for the perfect trade. It does not exist. Wait for the trade that gives you an edge. An edge is when an outcome is greater or more likely than another, period. You can sit there and study it and narrow it down to the 72.34567%, but it's meaningless for the very next trade because the data set you use to study it is changing dynamically with every trade. Okay. One thing I know, and one thing I hope you know, I know that I don't know what I don't know. If I don't know what I don't know, but I know what I don't know that I don't know, then the only thing I can do about it is size my position and manage my risk. I use scale outs, I use volume profiles and things like that to try to extract that edge and read it, but trading it is a simple fact of just putting it on, managing it. Talking like Rumsfeld, that's an insult. I'm just kidding. All right, so that's what I had. Trade well and trade your own plan. Your success depends on how well you trade, not how much money you make or lose. Don't focus on the money. I know it's counterintuitive, and I know your monkey's going to scream and yell that you can't lose the money you have in your trading account. But if you focus on that, unfortunately for you, it'll be just an intense struggle. It just doesn't go anywhere. Focus on trading well, mind your risk, let it rip. Let the trades rip, and try to get as many samples as you can to take those trades. Okay, that's the facts, and I'm sticking to it. Mike?
Hey man, fantastic webinar as always. I've got a couple of quick questions for you, and then we'll see how many you'd like to answer from the crowd. But I get to go first. Do you hold trades overnight, or are you always flat at the end of the cash session?
The only time I've ever held trades overnight is when I stupidly trade into the Eurex close and get myself caught, and then when that exchange closes, you're stuck in that position until the next open, which is like 8 or 9 hours away. So I just hedge in the U.S. market, and that's it. But generally, no, I don't. I like to sleep well, and my edge. I'd like to do a lot more of what I do best. So I can turn myself into a swing trader or an overnight trader if necessary. But I know what I'm good at, and if I do it well and I do it with size, then I don't have to worry.
So if you're in the middle of a position at 30 minutes prior to close and it hasn't quite got to your target, you're going to just close it regardless.
Absolutely.
Okay.
Absolutely. Yeah, I like to bank the outcome and clear the deck for the next day every time. I know others will put a stop in and sit through it, but it's just not my style. And the reason it's not my style is because I started as a high volume scalper, as a So's Bandit trading equities. So I started out at the mini tick scale and grew up from there. So I don't feel comfortable, but the other practical reason I don't do that is, as someone is holding that position from 1408 down to 1382 half, they're only able to bank, if there's a strict swing trader, they're only able to bank the difference between those prices, the number of points. But the way I'm trading, I'm able to multiply, in most cases, or often, not always, multiply the number of points 3, 4, 5, 6-fold because of the back and forth as it goes from the high to the last swing low. Do you follow what I'm saying? It just seems to me like it's more opportunity.
So let me, kind of along the same lines, do you trade just one single market simultaneously, or are you watching multiple markets?
I trade multiple markets. I only, like in our client only chat room and on Twitter and stuff, ES is the most popular product, so I tweet on that, but I trade multiple products. I have several products at the same I'm watching at the same time, and some of them I'll scalp the ES. I'll take strong trades in, so to speak. I'll take strong trades in, But like the DAX, I would scalp around a position until I have some room, and then I'll just let it flow. Same with the Russell and so forth. But every once in a while, I'll tweet or talk about gold if there's something interesting, and then always pop up a chat or a webinar, impromptu webinar when there's something else.
Right.
And I'm only doing that because I'm watching all these markets.
So I've watched a couple of your recent impromptu webinars, and I bought your webinar 3, and I can't remember which one it was in, but I know that you always advocate having a daily loss limit. So let me ask,
Yes.
do you advocate having a daily goal, at which point a trader walks away?
If that's a good question. I've been asked that several times. When I go through a rough patch, even though I'm intellectually against having a target, because what it does is it makes you focus on the money as opposed to the setup and executing the next edge cleanly. The truth is, when I'm going through a rough patch, and it happens, as the market changes, I have to go through a rough patch to adapt. Otherwise, I won't survive it. I will start just going for I call it putting up green, right? Just putting up 2 or 3 good trades and then just stopping for the day. It's not a dollar target. It's just when I feel that, okay, I have a streak of strong setups that I took and traded them well, and I'll stop just to build my confidence. And it's a good thing to do, I think, for somebody who's trying to get consistent, And that's what I tell a lot of people that I've tried to help, either privately or in our chat room or whatever. I say, do what it takes to get 2 points. Just get 2 points. That's your goal for the day. Get 2 points. And build a streak of days where you get 2 points. As you get 2 points, the fog is going to fall off your eyes, and you'll be able to see and get into the flow of the market. So it becomes almost like a runner who got injured and they're going through therapy. It's the upside target's almost like going through trading therapy. You're just trying to build your confidence through a consistent winning days. That's the only time I would go for that, though, because for me, I'll take the edge when it shows up. I don't care how many times it shows up. I mean, in 2008, there were days where I was trading like 19 hours in a day because it just did not stop, Right. You get into the ES and it immediately pays 34 points, without a scale. So those days I don't put a target up, but I think it's good practice when you're not consistent to put a target out there for yourself. But don't make it into dollars, because some people will get to, they'll have a $100 target. They'll have 87.50 up, and then they'll start to squeeze out that extra tick, and they give it back plus their stop for the day.
Right.
Don't make it a dollar target. Just tell yourself, I'll take 3 good solid setups today and stop. Or I'll trade my first hypothesis, and if it works, I'll trade.
Changing gears slightly, and if this is going to be a long answer, then feel free to skip it. I've heard you and of course many others talk about the market's only trending 15-20% of the time, range bound the rest. I decided recently to undertake that and try to prove it myself using my own statistical analysis in Excel. So let me ask you very simply, how do you define a trend day using hindsight? Okay, we're not trying to do it in real time. I want to know, was yesterday a trend day? What's the simplest terms? You've done that work, so I thought maybe you could give me a very straightforward answer.
I saw your question, and I actually intended to reply to it. It's better that I reply to it here. It saves me from writing a long email. But I define a trend day in the classic market profile sense, and that is continuous increase in rotation factor. What does that mean? It means that from the time the market opened until it closed, so there are several levels. One, from the time it opened till the time it closed, it had consistently increasing rotation factor. Rotation factor increases when on half-hour bars or half-hour segments, there is a higher high and an equal or higher low for an uptrend. So even if it pulls back on itself, there's a consistent rotation up through the day. The other factor, and there's an additional complication to that, but the other factor is I need the market to close in the upper quarter of the day's range. The market needs to advertise and auction higher prices and continue to get participation, as opposed to what we commonly see, which is it advertises higher prices and then all the sellers come in and bring it back to like the midpoint or below. You know, I want to see it finish in the upper quarter of the day.
Okay.
Those two criteria, if they're met, I consider that a trend day.
Let me ask you a trade management question, and I may have asked you this on the last webinar, so I apologize if I did. Sorry, I don't remember your answer. Under what conditions do you ever move your stop after you're in a trade? You know, under what conditions do you move it to break even? That's always a favorite. What conditions do you ever trail a stop?
Okay, moving to break even is simple for me. The trade had a plan and it had a goal. And and I always scale out. If the market, let's look at today. Hang on. I guess I can talk about hypotheticals, and the picture is better. Hang on. Do you see the chart?
Yeah, we got it.
Okay. So the short targeted on the way down. My scales were opening swing high, different than opening range. Opening swing is completely different. Opening swing high, which is the blue dashed line, which is coincided with the midpoint when I took the trade. So that's a scale. Okay. If I'm short from up here today, 90 quarter, and it gets down to a defined area where I'm scaling, and then it turns around and goes back up to my entry, I'm out. It shouldn't do that. If the market is in congruence with what I'm doing, with my hypothesis, if the market's supporting my hypothesis, it should not come back to entry. And so I'll scale, and if it comes back, I'm out. What I will not do is I get in, it goes against me, it comes back, and I'm short, and then I scratch. That doesn't work for me. As long as it did not breach yesterday's range, or the micro composite range, which is the last 2 days of balance, as long as it didn't breach 91.75 and hold, I'm going to stay short. My trade is still okay. It's just my entry is premature. So the only time I move a stop, and I don't use hard stops, and I don't advocate not using hard stops. It's just my style is to stay active in the trade as opposed to passive. However, I always advocate using a stop for those especially who are trading remotely and don't have as a reliable an internet connection or whatever. The only time I would move to a scratch is if it hits a spot that I've defined and it comes back to my entry. Then it's telling me, look, all right, we agree with you on the movement here, on the chosen direction, but we had support in another area, an area that I predefined, an auction-based area, midpoint, swing high, LVN, VPOC, stuff like that. Then it comes back, then I'm out because it's changing the probabilities for my trade. It's basically saying, look, we can't get into the opening swing, which is the first high that was put in before sellers came in aggressively and pushed the other way, and the opening swing low is the first low that was put in before buyers came in and pushed the other way. So that defines the market on open orders for the day. It defines where all the participants that stand on the sideline, where they came in and forced the market the other way. That's the opening swing. And then if it does get through the opening swing, now I'm looking for the open, and I'm looking for the opening swing low. The open is this dotted green line here. Today it was 87. So those are scale areas. Once it clears those, then I start to look at the bigger levels. Today, 82.50, 84.25, like I showed you on that composite. 84.25, that low before we just eat into this thin, unauctioned area. Then, so I'm looking at 85 as a possible scale. I'm looking at 82.50 as a possible scale. And all I'm doing with every scale is I'm improving on the short. By the time it gets to 82.50, my theoretical average, essentially, the price at which the market has to take me out on the number of contracts I have left for the trade to be a complete scratch, jumps up to 1400, 1450, 1401 on the trade analyzer. This theoretical average, the number shown here in big bold letters, becomes bigger and bigger and bigger on the short. Because as I'm banking profits, I have fewer contracts to cause damage in an adverse move, and that's what I care about. So I use the theoretical average as a scratching price often because I'm looking for the scale to improve my stop and still break even, essentially. Maybe that's complicated.
No,
I don't know.
no, I think
but that's what I do.
I think you explained it very well. So, and going back to just real briefly on the risk, you and I think have discussed this before, but it seems really, really difficult for a lot of traders to understand that their stop should be set to the point when the trade is no longer right. And how many times do I see, and I'm sure you see traders where they have this stop and then the market takes them out and then they get right back in the same direction. It's because the trade is really technically still valid. The stop was just not even close to where it really should be.
Their broker loves it, though.
Yeah, and of course then people immediately say, oh, well, I have to have a bigger stop, so now I'm going to risk, $2,000 per trade, and that's not the right answer either, Anyway.
Right. Essentially, in stop placement, unfortunately, most people are trading a leveraged product with too little money, so they can't change their position size to accommodate a wider stop. But stop placement has to negate the idea of the trade. So with today's trade, we opened below the 2 days, what I call balance days, the red candlestick and the one to the left of it. That was yesterday, Wednesday, and Tuesday. Those are balance days. I do not want to see, from an auction perspective, I don't want to see this market, if it opens below those days, especially below the composite LVN here, I don't want to see on a short that the market's going to the other side of that and then starting to eat into the balance day above it. So I don't want to see the market. So let me draw that. Let me draw the microcomposite. It's these 2 days. Okay, so these 2 days are balance days. The most accepted price is 97.25. I do not want to see this above 91.75 because if it does, if you look at this, you'll see that there's very little volume. You see how thin that volume is? There's nothing to hold this back if it starts to push up. I am wrong on the short on that occasion. Until then, I am not wrong. I'll take the heat. Okay, so I'm watching on the short, 91.25, 91.75. Don't want to see 92.25. No, don't want to see 92.5. I'm wrong at that point. And so that's why my scale is important, because it affords me the ability to extend my stop and sit and relax and see the market for what it is, as opposed to having this gorilla on my back going, oh my God, you might lose, So a stop placement for most people is like a tick above the last high, a tick below the last low. That's a sucker stop. Everybody that's ever traded professionally knows that that's a sucker stop. It's not a very good way to use a stop. It's so easy for me to push in certain products like the DAX or the Russell to push to one tick that high, because I know a whole bunch of guys are going to be sitting there with their market stops, and it'll give me at least 3-4 ticks.
So I'm willing to risk. Let me ask you this.
Yeah, go ahead.
I've heard a lot of people talk about that, and I have my own approach. I'm curious what yours is. Some people say that what you should do is, in fact, hold out, have patience on your trade, and if you would normally place, I say the word normally, if a rookie trader would place their stop there at that very gullible or likely position, then maybe a more advanced trader, that's where their entry point is. Do you agree with that?
Um, Possibly. I mean, I don't know what everybody's doing. I know quite a few professional traders. I mean, I've only been around professionals, but the bigger thing the professional is doing is he's basically saying, okay, so I lose $3,000 on this trade if it goes clear against me. But most guys don't take a position and just sit. They actively manage the position to improve the loss if it ever occurs on their stop. So they're not looking for that. They're not basically saying, if it goes against me 20 points, who cares? But they're also not putting their stop one tick above the last high. So I actually don't know anybody who would wait for it to one tick the high to get short. Most of them will get in with the crowd,
Right.
just like everybody does. But they also know, they factor in the fact that it's probably going to take out the high. It's probably going to do a quick squiggle past the high, but then all those guys get flushed out and it
Right.
just resumes its trend.
Right.
So they factor that into their stop, you know.
That's what I do too, because like you said, you don't know what's going to happen, and that's why I advocate for me personally scaling in, because I don't know. It may not ever even get up there, in which case I will have missed the entire trade. So I put on a small position now, and then I maybe add to the position after it takes out that high. Changing gears slightly, and I know that you want to get going, so that just let me know when you want to stop the questions. But every now and then we see a rash, or I see a rash of new posts on the forum from people that are they're at their wits' end. They're posting stuff like, it's not possible to make money trading. It's all a game. No one really ever makes money. They don't think that anyone can make money trading. Obviously, we know that people can make money trading, but let me ask you this type of a question, or let me ask you in this way. Do you agree that there's a extremely high cost of entry in terms of commission, for example, or slippage? And do you agree that someone that's only taking, let's say, 10 trades a year versus someone that's taking 10 trades a day, the more trades you take, the more that barrier or those costs or that risk or whatever word you want to use, the higher it becomes? Is it possible for a very active retail trader that does not lease a seat and they're paying, level 1 commissions, and they're trading, from their house and whatever state, far away from the exchange, and maybe they have a slower connection, more latency, and all these types of things. Is that still possible for that trader to be long-term profitable, or do they need to get into a bracket where they are at least trading enough volume to lower their commissions by leasing a seat or et cetera? What do you think?
Well, it makes no sense to consider membership, even if it's an ECM, which is something you pay $2,000 for the application, and then you set up a corporation, and then it automatically drops your exchange fees by $1, which is a lot. It doesn't make sense unless you're averaging 500 round turns a month, because there's a minimum of 1,500 round turns per quarter. But we have clients that just come in and just bang away, and they're retailers paying normal, commissions, trading on Ninja or VK Trader or whatever, using just normal tools, our tools, and still do fine. The problem with the retail crowd is not that it's a rigged game, because you know what? I don't know what tomorrow's going to bring, and I don't know if it's going to be a winning day or a losing day. The difference is I've done this for long enough, and I've got enough samples to know what I can and cannot do. Retail folk don't allow themselves that opportunity. They do so many, I don't know how to call it, unwise things, because they are ill-informed. There's so much misinformation out there, and that's really why I came on Twitter, and it's absolutely why I started this brokerage thing. is to try to put that to rest. There's so much misinformation that leads these people to just spin and spin and spin and spin, and then eventually they run out of money or they run out of time. So they don't have the opportunity to actually create a big enough sample to see the market enough and participate in it to the point that they can actually do something with it. Trading is a professional sport. It's a high-performance professional sport. You will not become a professional basketball player by going out and playing a 3-on-3 game every weekend. It needs to be something that you're immersed in, something that you do all the time. It's what differentiates Michael Jordan from everybody else, or our Chicago Bulls, Derrick Rose, from everybody else. It's because it's all they eat, drink, dream about, think about. And then in addition to that, they have the boost, just like I did, of being in an environment where I see what others are able to do, and so I don't have that doubt. I mean, I took a it was hard for me to make the turn. It was painful. I was very attached to winning. I was always successful, whatever I did, so there's a lot of ego to get through. But you know what? There were traders there that would come in and bang on the DAX and walk out with 22 grand for the day. So I knew it was possible. I had the same tools. I had the same information, but I didn't have the same attitude in mind. And that's what this talk was about. It was about fixing that, okay, trying to make you aware that getting that extra indicator on your Ninja or TradeStation isn't the secret sauce. The secret sauce is you. Do you believe that you can make it? Now, if you show me that one trader or multiple traders who said, this is a rigged game, nobody ever makes it, my answer to them is go, because it's hard enough as it is. Coming in with that attitude, with the belief, and expressing that belief in the form of words, and I believe in the law of attraction, converting a thought into action only makes that action stronger.
Right.
So talking about how it's rigged and nobody ever makes it, dude, you don't have a chance.
Right,
Even
absolutely.
if I handed you everything that I ever did to make you profitable, you have no chance.
It's all about
so
the attitude.
Move on.
Yeah, you got to have the right attitude. And I guess maybe one of the last questions, since we're coming up on 2 hours, I want to see what you have to say. Here's my thought process. In the beginning, I always see traders, searching. They'll get down far enough on their journey that they realize that maybe they're to blame. Maybe they can't trust themselves. They don't have the discipline. They move their stop, whatever it is, right? They realize that they're the problem. So then they start searching for something else to solve that problem for them, a trading room or some good famous person on Twitter or whatever, right?
Follow someone else's signals.
Right. So they go down that path, and then of course that doesn't work either, and they really just don't know what to do. And I try to get them to journal in the beginning and write down things as it's happening and as close to real time as possible, because I found, at least with me, that I don't want to say I was lying to myself, but I was deceiving myself. My memory of what I swore the event was not factual. And when I started recording myself, like using Camtasia, I would record my screen, my chart, my DOM, and using my webcam, my body, and I would see what really is happening. And it makes you, when you're watching that video, you want to shoot yourself because you're acting so stupidly, and it's like your mind blocked that out, what really happened, and you come up with all these reasons that you did something.
That's the purpose of your monkey, is to protect you from harm, and harm comes in the form, having a rhinoceros chasing you through a jungle, to your brain is the same effect as sitting in a 10-lot loss for 10 points. It's the same effect, and as you're running through that jungle and the branches are cutting your legs and whatnot, you're not going to feel that, right? You're not going to feel it until everything calms down.
Right.
Your brain is designed that way. You can't change that. You can't change that programming. You just have to be aware of it and put things in place to protect you from that happening. That's what I did. As a prop shop owner, my traders did not get setups. I didn't tell them how to trade. All I did who's managed their risk and their psychology. It's like a coach. Do you think when Michael Jordan went, from North Carolina or whatever to the NBA, do you think the coach said, okay, forget everything you've ever learned, let me show you how to play basketball? No. The coach simply honed their edge. It's your edge. It's in your nature. It's the way you do things.
So if you're
and
telling
everybody has a unique way.
Right, but if you were going to tell somebody that says, you know what, I hear what you're saying and I'm ready to really give it another go, a good solid go, what specific advice, what should someone start doing today with their trading to help them realize the monkey and to control him a little bit more?
If you have a sim, do coin tosses. It's probably the most immediate and effective way for you to start your your questions, the last couple questions, hit one subject. And again, I'm not a therapist, but this is a fact. At least the fact that I'm aware of. Your questions are about behavior modification. This is your culprit. This is the culprit for everybody. I would rather go out and buy P90X and put it on a shelf than to go out and actually exercise because it's so much harder for me to modify what I'm doing, and it's much easier for me to just pay for something that promises to modify who I am and what I'm doing. Your biggest challenge is you, and so that's what we do as human beings. This is what we're taught, and there's an entire retail consumer industry and trading education industry and brokerage industry and so forth built around this fact that you as a human being are not able to take control of yourself. So what do? You start to break down. Every one of us has a mental structure built into us. We all have this structure that was built from when we were a child. Our experiences teach us certain things about life. And so we build these structures like a fort. And we build and build and build, and we make it stronger with every experience. And a lot of it doesn't serve us in trading and in life, actually. In theory it does, but in life it doesn't really serve us either. What you have to do to reverse this, and this is a hard fact, and it's the same for professional sports as it is for professional anything, in any aspect of your life, you have to start breaking down those structures that don't work for you. How do you do that? You do that through a process called integration. Again, more psychology. As you notice, talk about psychology a lot. Integration is basically taking a belief that you're aware of and changing a small aspect of it. So if you are someone that does the homework, blah, 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 and sees that you're doing something wrong every day, pick one small thing and change it. If you're a guy who's really fat and you're tired of being fat and diets don't work, whatever, you know what's going to be successful for you? What's going to be successful is to take a small thing and just stop doing it or start doing it. Start walking a block before you catch a bus. It's that simple. It seems ineffective, but it's that simple. It's not going to burn the calories, and you're not going to start looking like Brad Pitt in a month. But what it does is it starts to weaken that structure that's causing the condition that you're trying to change. This is something I could talk about for 10 hours, but it's a fact, okay? So how do you start to break that down? You take it in small bits. And that's what structured learning environments are. And ultimately, and we're in the process of building this through my brokerage, and I'm not trying to plug it, it's just this is dominating my life right now, is we're trying to create a structured learning environment. In a structured learning environment, you are being forced externally to make that change. So that's why we don't homeschool our kids. We send them to college. That's why, or we send them to school. That's why, when you have a structured learning environment where there isn't a whole bunch of BS and egos and people pretending they trade or whatever, you start to recognize what's around you and see what others are doing relative to what you're doing, and you start to see that what they're doing works or doesn't work, and you start to adapt it naturally. So You want to be a surfer? Go to Hawaii. You want to be a surfer? Go to whatever, California, go to Australia. Don't try to be a surfer at the local wave pool in the middle of Oslo. It's not an effective way to do it. So what you need to do is be part of a community that supports that thing you want to achieve. So buying P90X to lose the 300 pounds because the guy on TV said he lost 160 in 3 months, who's actually paid to say that, is not realistic. What you have to do is then change your environment to change your behavior. Alcoholics are absolutely unsuccessful at quitting without AA or some sort of a support group, and that's why support groups exist. Now, how do you create a support group that is actually supportive? One, you need commitment. The people coming in need to be committed. That's, for example, why we require $10,000 minimum. You need to be committed to actually trading. Two, you create a community with some structure. At this time, we do homework. Here's how we look at homework from macro to micro, and then, you know, you need to control your risk. So here's you're screwing up, you're eating up 30–40% of your account. We need to structure your risk a little differently because you're not doing it for yourself. These are things that we do on a best effort basis, and obviously we need to automate it or do it less on a personal basis as the business grows, as a brokerage grows, but it's what's necessary. Right now you don't have that. The only place you can get that is a prop shop because you're trading someone else's money, and a lot of prop shops don't even do that. They just basically play the statistical game. We'll get 20 guys in, 2 guys will make it big, the rest will just, 10 will cut, and then the rest will just kind of muddle along. But if you have a better structure like I had, where you come in, you're trading with me, and we're walking it together, and I can't hire the next guy until you've paid off your margin and your loss, then you have a structured environment. It's very intense, and it's very energy and time consuming, but that's what's needed. People have a hard time modifying their behavior, and they seek answers by paying for a book on Amazon or paying somebody $5,000 for a weekend course. But unless that somebody is following your progress and pushing you and reminding you to do the little changes that you need to make, it's worthless. It truly is.
Right.
So a learning, going off on a weekend symposium or course for trading without some sort of a follow-through process is really worthless. So it's all about behavior modification for anybody that's complaining that they keep repeating the same mistakes.
Right.
They're not able to modify the behavior in any other aspect of their lives if they're having that much difficulty. And that's why it's good to it's hard to find prop traders. I stick with athletes. I stick with professionals. They are guys that are required to modify their behavior. Military men are required to modify their behavior, and they get good at it. Those are the guys that make good traders.
Right. So let's do this. Let's make the next thing the very last thing. So far, I think everyone can agree that FT71 has done a fantastic job of putting together an educational topic, and now I see a lot of questions coming in about his services and brokerage, and I think everyone can agree that he is not trying to sell anybody anything. So I want to give him an opportunity to answer what a lot of people are asking, which is how do they sign up for whatever it is you're doing.
Oh my God, that's where I leave it to Anthony.
Do we have contact info or website?
And let me type it in, I guess. Is there a way to type this in and just send it to everybody without selecting a particular question?
If you could do it in Notepad, it would be better because the questions aren't part of the recording for later, and that way you can.
Okay. All right. So let me pull something up here. So contact us here, and again, it's Anthony's job to market the brokerage. It's not mine. I come in, I trade, I'm part of building the business, but I'm building it for the purpose of improving the opportunities that traders have. All the commission stuff, all that stuff is handled by others. I'm not interested in it. So I'll let you know, just there's a contact form. This particular website page is a landing page. Our real website's being built, but this takes care of us for now. And there's a contact form on there, and you could just shoot a message over to Anthony, let him know you're from Big Mike, and he takes care of you. We're not trying. This is not a business plan where we're going out there and we're advertising to the whole world. We don't advertise. We haven't advertised yet. Right now, we're trying to build things organically, build a community, a solid chat room, an environment for traders, and that's really my key objective. And then if the business does well, it just means, for me personally, it means that I can create better tools, create better services to further that along. Essentially what I'm trying to do is create what I had in a prop room, or as closely as possible, and make it something that'll change the way brokerage is done globally. This is really what I'm going after, to be honest with you. So it might sound salesy, and I keep referring back to what I'm doing, but I don't see tweeting and blogging and providing short educational webinars as a real way of helping traders. The way to help traders is to actually just see what they're doing wrong, help them create a plan for it, and then go from there. Okay?
I think that you should give yourself a little bit more credit on the webinars. I've watched a few of the impromptu webinars that you do, and for anyone that's not familiar with them, if you follow him on Twitter, every now and then he'll send out a tweet with a link to watch a recording, like a trader intervention. That's one of my favorite new things to watch. I hope it's not because I feel attracted to someone else's pain. Hopefully that's not it, because I see so much of myself, right, or what I used to do, and all these people, and it's just amazing, you know, all the similarities that everyone goes through. So I highly encourage you check out his Twitter for those types of talks, and then also on his website, FuturesTrader71.com. There's 3 or 4, I forget how many webinars that you can buy and watch. And I think webinar 3 is the one that, excuse me, webinar 3 is the one that I always hear being talked about. So that's the one that I've purchased and checked out for myself, and
that's the monkey webinar.
Right.
It's probably the most important. It's probably the most important one. Are you talking about the trader case study here, September 1st of 2011, where the guy lost like 40 grand or something?
No, it was a real recent one. I can't remember the gentleman's name, but he blew out his account, and he was talking about asking relatives for money.
Oh yeah. Okay.
Yeah.
Yeah, that's the September 1st one.
Okay.
Anyway, there's a bunch of them in there that are open to the public, and then the rest are available to anybody who donates to any of the webinars. And it's a donation. It's not really a real way for me to. It's not for me. But anyway, I'll leave it there. I need to run. I really appreciate the opportunity. I did want to make this a short one, but it's really hard to talk about trading and not get into all these nooks and crannies during the conversation.
Right. All right. Well, thank you very much, and look forward to having you back here sometime again soon. Thanks, guys.
Thanks so much.